Most people think you need hundreds every month to invest. But what if just $25 a week could lead you to financial freedom? Dividend investing isn't just for the rich. It's the most underrated wealth strategy for regular people. And the key? It's not just what you invest in, but when you make the switch. Can you really build lasting wealth by investing just $25 a week? What's the catch with dividend investing? And how long does it actually take to see real income? In this video, you'll get clear answers with real math, real tickers, and a strategy that grows with you. I've broken this down into a plan anyone can follow, including a powerful shift most investors miss. Stick around until the end, because I'll show you when to switch strategies for the fastest path to passive income and how to do it step by step. If you've ever dreamed of earning money while doing absolutely nothing, dividend investing is the closest thing to that reality. Think of dividend investing like planting an apple tree. In the beginning, it's just a seed, small, easy to overlook. But with time, it grows into something that feeds you every single year. Dividend-paying companies like Coca-Cola, Procter & Gamble, and Johnson & Johnson share a portion of their profits with shareholders in the form of cash payments called dividends. You're literally getting paid just for owning part of the business. But here's where it gets powerful. Instead of spending those dividends, you reinvest them to buy more shares. This snowballs over time and is what's known as compound growth. You're earning money on your investments and on the money your investments already earned. Let's say you invest $25 every week. That's $1,300 per year. Over 20 years, assuming a 10% annual return and reinvested dividends, your account could grow to over $74,000. And at that point, with a 3% dividend yield, that portfolio could pay you around $2,200 per year in passive income, or $183 per month. Keep investing, and by year 25, your portfolio could cross $130,000, generating nearly $4,000 per year in dividends. That's the true power of dividend investing. Small, steady steps that lead to income for life. If this gain seems too slow for you, wait till the end. I'll show you the secret switch strategy that speeds everything up. What if I told you that a simple $25 weekly habit could completely change your financial future without ever needing to pick a single stock? Most people assume investing is only for the wealthy. But the truth is, consistency beats intensity. It's not about how much you invest, it's about how long and how consistently you do it. So let's break it down. $25 per week equals $1,300 per year. That's less than most people spend on streaming services or takeout. Now apply that consistently over time. Assume an average 10% annual return, the historical long-term return of the S&P 500. Here's what it looks like with reinvested dividends. After 5 years, about $8,300. After 10 years, over $21,000. After 15 years, about $41,000. After 20 years, nearly $74,000. And here's where dividends kick in. A portfolio worth $74,000 with a 3% dividend yield generates $2,220 per year, or $185 per month in passive income. That could cover your phone bill, internet, or even groceries. And if you keep going, by year 25, you could hit $130,000, producing almost $4,000 per year in cash payouts. This is all from a small automatic weekly investment. No trading, no stress, no hype. The real secret is showing up every week. You don't need to be perfect, you just need to be consistent. And by sticking to this plan, you're not just investing money, you're buying your future freedom. Choosing the right ETF is the difference between slow growth and real momentum. Get this wrong and your money crawls. Get it right and you build wealth passively. Dividend ETFs are the perfect tool for beginners. They bundle dozens or even hundreds of dividend-paying companies into one investment. That means instant diversification, lower risk, and no need to pick individual stocks. But not all dividend ETFs are created equal. Some chase high yields that look great on paper until the payouts get cut. Others focus on steady growth and reliable income. Here are 3 of the best picks for beginners. SCHD, Schwab US Dividend Equity ETF, focuses on quality U.S. companies with strong financials and consistent dividends, around 3.5% yield with a history of annual dividend growth. VYM, Vanguard High Dividend Yield ETF, offers broad exposure to high-yielding U.S. companies. Slightly higher yield, 3.8%, but less emphasis on dividend growth. DGRO, iShares Core Dividend Growth ETF, targets companies with a history of increasing dividends each year. Lower yield, 3.1%, but stronger long-term growth potential. If you want balance, solid yield, and long-term growth, SCHD is the top choice for most investors. It's reliable, consistent, and backed by companies with real earnings. Investing in a fund like SCHD gives you exposure to strong businesses and growing payouts without the need to research individual stocks. That's smart, simple, and built for the long haul. Dividend investing sounds safe, but is it really? What happens in a market crash? And can dividends actually disappear? Let's get real. No investment is risk-free. Even dividend-paying companies can face challenges. In 2020, during the COVID market crash, over 200 companies cut or suspended their dividends. If you were holding the wrong stocks or ETFs, your income took a hit. But that's exactly why diversification matters. A well-built dividend ETF like SCHD spreads your risk across dozens of companies. If one or two cut dividends, it barely dents your income stream. Still, you need to understand what you're signing up for. Dividend stocks can underperform in certain environments, especially when growth stocks are booming. And if interest rates rise, investors may prefer safer options like bonds, putting pressure on stock prices. Also, high-yield ETFs can be a trap. Some promise 5% or 6% yields, but the underlying companies might be financially weak. Those dividends aren't sustainable, and once they're cut, you're stuck with losses. So what's the smart move? Focus on consistency over flash. SCHD and similar ETFs have not only maintained payouts through market cycles, they've increased them. For example, SCHD's dividend grew from 63 cents per share in 2013 to $1 in 2023, nearly doubling over a decade. That's steady income growth, not just price growth. Understand the risks, avoid the traps, and you'll stay in the game long enough to win. What if you could build wealth faster without giving up dividends? There's a smarter route most investors overlook. In the early years of your investing journey, your portfolio's growth matters more than the dividend income it produces. Why? Because you're reinvesting everything and growth accelerates compounding. That's why starting with a growth-focused ETF like QQQM can supercharge your long-term results. QQQM tracks the NASDAQ 100, which includes tech giants like Apple, Microsoft, and NVIDIA. These companies don't pay much or anything in dividends, but their stock prices have historically grown much faster than dividend-heavy sectors. Let's compare. If you invest $25 a week into SCHD over 20 years at a 10% average return, you end up with around $74,000. But if you put that same amount into QQQM with a 14.7% average return based on its historical performance, your portfolio could grow to over $121,000 in the same time frame. That's a $47,000 difference just by changing your strategy. The trick is to start with growth, QQQM, then switch to a dividend ETF like SCHD once your portfolio has scaled. You lock in the gains, then convert that capital into a reliable income stream. This two-phase strategy lets you build wealth faster in the beginning and collect bigger dividends in the end. The best of both worlds. You've built up growth. Now it's time to protect it and turn it into income. But timing the switch is everything. Here's the trap. Many investors ride growth ETFs like QQQM all the way up and then all the way back down. Growth funds can drop fast in a bear market, sometimes 30% or more, while dividend ETFs like SCHD often fall less due to their stability and income appeal. That's why the switch from QQQM to SCHD has to happen during a bull market, not after a crash. You want to lock in your gains while growth is still running hot. If you found this video helpful, don't forget to subscribe for more ETF breakdowns and strategies to grow your wealth. If you want to see which dividend ETFs pay the most and grow the fastest, check out my video on the best dividend ETFs right now. And if you'd rather not worry about timing the switch, watch my 3 ETF portfolio strategy built for long-term growth and automatic diversification.